We're standing by for that Bank of Canada interest rate announcement in just a few minutes' time. Stuart Paul, an economist at Bloomberg, reckons that Tiff Macklem and his colleagues have cover here for a rate cut. For example, we got a downside surprise in second quarter GDP that was weaker than expected, and we've had what Bloomberg calls two dismal labour reports. Net job gains for this year below 50,000. OK, well, let's get more from an economist who is standing by as well, David Doyle, head of economics at Macquarie Group. David, thanks very much. We're only minutes away. Do you think they'll cut?
Yeah, I mean, I think it's pretty much baked in the cake, Andrew. We're expecting 25 basis points. I'd echo your comment that you mentioned at the outset, which is that the labor market, I think, is really going to push them over the line here. It suggests that the output gap has widened with the unemployment rate now at 7.1%. That's up around a half a percentage point since the start of the year. So I think there is a strong case for a cut in just a few minutes.
Will Tiff Macklem feel under pressure, though, to sound slightly hawkish? I mean, he doesn't want to give the impression he's weak on inflation.
No, I think, yeah, I mean, that's a good point. I think he'll also speak to some of the more encouraging inflation figures that we've had in recent months. Now, they're still, I would say, a little bit elevated relative to that 2% level, but they certainly are a little bit more encouraging than what we saw earlier in the year. So I suspect that he's going to have reduced concern on the inflation front, again, relative to what you would have had a few months ago.
You are looking for a cut of 25 basis points today and then another one next month?
That's correct. So we think they'll have back-to-back cuts. I suspect that, when the monetary policy report is released at the next meeting, that it will support, again, a further easing in policy. I don't think they're going to come off the bench and just cut once. I suspect if they do cut, it'll be back-to-back. So, yeah, we're looking at a couple of cuts here in the near term.
What do you think of the warning we've heard from some economists that really interest rate cuts aren't a great tool for dealing with tariff-induced inflation?
Well, look, I think that they're not necessarily, like, cuts themselves aren't likely to solve any sort of inflationary problems that could come about. In fact, what's happened is that the output gap has widened, right? And when the output gap has widened, what as an economist we would expect to see is that inflation should come in over time. Now, there might be a little bit of a blip up due to the uncertainty created by tariffs, but we suspect that over time, inflation in Canada will come in, reflecting how much unemployment has risen and the size of that output gap. And so that, I think, is a clear justification for not huge easing, but a little bit more easing here. I think it's very defensible.
And I suppose the Prime Minister, Mr. Carney, has backed down on some of those retaliatory tariffs. In fact, many of them that he slapped on the US. And so that reduces the inflationary pressure on goods coming in from the US.
That's correct, right? So I actually don't think that Canada's retaliatory tariffs are, what we should be worried about when it comes to the tariff impact of inflation in this country. It's more so goods that enter, into the U.S. where you see tariffs imposed on them, and then there's pricing decisions that are made on a North America-wide basis from companies selling goods to both Canada and the U.S., where the Canadian prices rise to reflect potentially what's happening in the U.S. That's the source of goods inflation, where I think you could see more upward pressure in Canada. But again, I think there's a clear offset to that from the widening output gap that we're seeing.
Let me cut you off, sorry. The Bank of Canada is, in fact, lowering the key rate. Breaking news, Bank of Canada cutting its key interest rate by 1/4 percentage point to 2.5%, as analysts had expected. We'll have a look at an intraday for stocks in a moment. Bringing the rate down amid a weakening economy. Remember that GDP dropped by about 1.5% in the second quarter. And we've also got slowing population growth. A little bit of pressure right now on the Canadian dollar, but this was fully discounted in the market. Exports sliding in the second quarter, so they do have plenty of cover for doing this. I'm just waiting to see what commentary is in the actual release, but certainly bringing it down. And right, that's interesting. The governor saying that shifts in trade will add cost to the economy even as activity slows. Hard to predict extent of cost increases and price pass-through, but also saying, Tiff Macklem saying, less near-term uncertainty. The focus is now on the USMCA review. We are back with David Doyle, Head of Economics at Macquarie Group. David, I know you've had basically no time to look at the commentary, but no surprise here.
Yeah, I mean, this I think was largely expected by most economists, that they'd proceed with a cut and that they'd have a strong rationale for doing so. I mean, I'm keen to read more into it and see what Governor Macklem communicates at his press conference, because that'll give us more of a sense in terms of what they might be thinking about on a go-forward basis. But clearly they've delivered in line with expectations this morning.
Macklem saying that he'll proceed cautiously on future rate decisions. And the target, of course, is 2%. And they're pretty close to that, or the midpoint of 1 to 3%. But the core measures have been stubborn lately, but they seem to be making progress on that front, even the core underlying inflation.
Yeah, so I think the measures that the BOC is most focused on, they're median and interim inflation, which effectively reduce the impacts of outlier categories on the inflation figures. And they suggest that, you're still at 3%-ish on a year-over-year basis, but the monthly data has been encouraging over the last, 3 or 4 months. We've seen the 3-month average trend down. And so I think that there's, cause for optimism there that, we're sort of past the peak point of concern when it comes to those underlying measures, and that we should see encouraging results going forward from them. And I'd add to that the traditional core inflation that the BOC, had highlighted in previous cycles, which of course strips out food and energy costs, is actually even lower. So that's at about 2.4% on a year-over-year basis. And the monthly numbers there have been very, much more subdued over the last couple of months. So I think that reinforces this narrative that, we're not in the all clear yet on the inflation front, but certainly the recent data have been much more encouraging than what was the case earlier in the year.
Yeah, they're saying that preferred measures of core inflation on a monthly basis, that upward momentum in those seen earlier this year has dissipated. So we can see actually Toronto stocks in positive territory right now. We think the numbers continue to suggest underlying inflation is running about 2.5%. So I guess that's within their range. They're happy with that, would you say? 2.5% core inflation?
I mean, I don't want to put words in Governor Macklem's mouth, but I don't think that he would say that he's happy with 2.5. I mean, he's probably happy with the progress that we've seen from the more elevated levels earlier in the year. I think he'd like to see it get back to that 2% target level. And certainly, though, they'll be happy with some of the more recent monthly data, which have been, much more encouraging than what we saw earlier in the year.
Macklem says 3 things have come up since our July decision. The labour market has softened further, and I know you stressed that. Upward pressure on underlying inflation has diminished, and and also he's citing the removal of most retaliatory tariffs by Canada. There's less upside risk to future inflation. So they're all points that you addressed. He says we'll continue to assess the risks and look over a shorter horizon than usual. Would you attach any meaning to that?
Yeah, well, that might mean is that, as economists, often we look at the output gap as driving, where inflation will go to over time. And so with the output gap that we have today, with unemployment, over 7%, you would normally look out into 2026 and say, this output gap is likely going to mean that inflation starts to come in and potentially even fall below 2%. I think what the governor is suggesting is that, because of the uncertainty, because of what's happening with global trade and the relationship with the U.S., we can't look out, that far with that much assurance. And so we're going to look at things on a little bit shorter term of a horizon, which, I do think makes sense in the current context.
And I mean, this is not news, but he highlights the fact that businesses are cutting back on investment. Many businesses have told us they've paused investment plans given uncertainty about US trade policy. Hardly surprising. I mean, this is not good news for an open economy like ours. And again, they're talking about low population growth, which is likely to push down or tend to keep down aggregate household spending.
Yeah, I mean, all those points, I think, are factors that are impacting the Canadian domestic economy. I'd say that, the business investment in particular, this has been a long-standing challenge for Canada, is that fixed business investment has been weak or trended sideways or down for the bulk of the past 15 years. And to me, that is the key long-run challenge ahead for Canada, is how do we get the animal spirits going? How do we get business investment to pick up steam again and become a true growth driver for this economy?
David, thank you very much indeed for giving us the time this morning. David Doyle, Head of Economics at Macquarie.